It's Brian Preston, the Money Guy.
All right, Brian, this next question is from Mac. It is from Aiden. Sorry, it was not Mac. I was yelling. I'm still getting used to my my new machine here. This is another really great one for young people. Aiden says, for people in their 20s, does it ever make sense to choose a smaller student loan monthly payment to split that money into like brokerage and IRA and then pay down the loans in the future out of their taxable account in their 30s? I know there was a lot in there. This is what he's saying. Does it make sense for me to pay less on my student loans in my 20s and then maybe shift my priority in my 30s, or then maybe try to build assets in a brokerage account in my 20s instead of paying off the student loans? Is there a way to think through that? Because I think that a lot of our folks, both now as well as listeners that are going to be becoming listeners in the next 5 or 10 years, student loans is going to be a big thing. It's going to be a huge issue. What would you say, or how would you encourage them to think about prioritizing paying that off and doing that well in the early years of their career?
Aiden, great question. Bo and I were at the University of Georgia 2 weeks ago. Getting that Bulldog 100 award.
Yeah, that Bulldog 100.
But we set up
2 weeks ago.
We held court in a bar, and the fact that we basically set up and for our own entertainment, because it was all the sororities were having father-daughter weekend or whatever. So there was lots of men about my age, unfortunately, there with their adult daughters. And it was just so interesting talking to all these students, because we asked some questions. We were like, how much student loan debt did you have? And surprisingly, I think about everybody we asked that question to gave us an answer. And what I found interesting is even if they said that it was covered, when we talked to their fathers, we're like, I'm never going to be able to retire.
Yeah.
Because, guys, it is sad. I mean, we have turned the institution of education, higher learning, and we really turned this into a bad thing in a lot of ways, is because it's just so not right that when I went to University of Georgia, it was $3,000 a year to get my education. And now we're hearing about kids that they're racking up, $25,000, $35,000. They're coming out of debt. We heard ranges. I think on the low end,
we are six-figure range.
Low range of 40-something thousand to the high range of close to $200,000 to get out of college. It just makes me so sad, because I know what a weight that's going to be on going forward. So this is for the people who maybe you're trying to figure out for your own kids what college they should go to or what majors. Pay attention to this stuff, because it does break my heart when I hear about people having such huge runaway student loan balances, because it's unhealthy. This is not sustainable. And you and I have, and this is a little outside of what Aiden's asking us, I'm worried the institution of education is going to have this cloud hanging over it because of student loans, that the next generation, your kids, if you have a lot of student loan debt, you're probably going to be like, hey, why don't you measure twice before you figure out if you're going to go strap yourself with all this debt right as you're starting out. We get passionate about this, because I realize how big of a deal it is, because I love education, but I do not like what education is doing to the younger generation. So let's figure out how we can help Aiden here. Now, look, we've already done some of the groundwork on this. We talk about, you have to think about this from an incremental decision standpoint of what each dollar can do to be maximized. And in your 20s, we know we have some things in conflict. In your 20s, every dollar has so much opportunity to grow for you long term that I have this koozie here that $1 for a 21-year-old has the potential when they retire at 66 to become $88. Right. That is a lot of value there that does not need to be overlooked. But we also know student loans, we need to get those paid back rather quickly. So what we've done is we've tried to turn it into, how do we combine the behavior with the math? And we actually put some interest rates on this. If you're in your 20s, and we took into account the risk-free rate of return and some other things when we came up with this concept, if you're in your 20s and your student loan rate is less than 6%, we consider that kind of a lower, look, that still sounds higher, but there's enough opportunity for what your money could potentially become that it makes sense that you might want to prioritize investing in go through the financial order of operations. Go to moneyguy.com/resources. You can download this for free. We also have at learn.moneyguy.com a deeper dive course. but we do want you to maximize paying down. You first the high interest debts, emergency reserves, then there's the Roth IRAs, the employer match was step 2. Those things were super important to take advantage of first. But once you get to that hyper saving where you're saving over 25%, I will tell you, I think there is going to come a point where you're going to want to prioritize that interest payments. Now, look, some of you, because interest rates are going to have started going up. You have student loan rates at 6 3/4, and they're probably even going to be even higher going forward in the future at some point. That's not low interest debt anymore. That kind of falls now into once you're, in that higher interest rate, you need to prioritize that after the free employer match. Pay attention to those things, and I'll finish the drill. 20-somethings, it was 6% from our research. 30-somethings, it was around 5%. For 40-year-olds, it was 4%, and then by 50, you don't need to have student loan debt. Do not have student loan debt. So realize that's a combination of math with the analytics of what's the opportunity cost. We try to take into account a lot of variables there, but prioritize putting your money to work. But do think about how can I get out of student loan debt. And the reason I said the 25% is because right now student loans are at zero. They're essentially deferring
right now.
the interest compounding. So a lot of you, and look, I get it. The interest rate's so low that you're like, well, I definitely ought to be doing the Roth. I agree when you're doing Roth and getting to that 25%, but I do think once you get over 25%, let's try to figure out how we can get rid of the student loan debt pretty quickly.
I love it. Love it. Love it.